999. I'm not just saying no in German. I'm saying that there's 9 more days in the end of this year. And so far, it looks like the stand-up rally is going to be canceled, which means it's probably time that we start talking about what's going to happen next year. And next year doesn't look so hot. And I want to draw some attention to my favorite Japanese analyst, Weston Nakamura, who I think gave some great warnings about what's going on with bonds that even I missed, and a lot more. So while we're talking about bonds, this might be a good moment to also say, hey, give the video a like, maybe subscribe to the channel. It helps so much. So last time we were talking about bonds, I said, hey, I think this is a short-term top. I'm going to go ahead, take some allocation off, and I want to buy back in. Now we ended up buying back in a little bit early. It was intentional to be early because I want to keep pushing this trade. Then I actually got burned out of some of this position. We saw major capitulation in bonds on the news that Japan was going to start doing monetary tightening. This was a little bit confusing for me, and I was having trouble piecing it together. And whenever I am confused about when Japanese market is affecting the US market, I always turn to one of my favorite Japanese analysts, Weston Nakamura, who's actually an FX trader. If you're not sure what that is, that means he trades currencies mostly. So let's go ahead and play this clip from Weston Nakamura and kind of get some insight on what he's saying right now.
So the JGB market clearly has direct implications on the U.S. Treasury market. The U.S. Treasury market currently is in a state of illiquidity and volatility that are feeding off of each other. And so one day, at some point, you can find yourself waking up to a situation that the UK gilt market was in, but happening in the U.S. Treasury market, where you see the long end of the U.S. Treasury curve, 30-year U.S. Treasuries starting to yield spiking like 100 basis points in the week, and then the Fed would have to step in and directly start buying 30-year U.S. Treasuries. And if that happens at the same time, timing-wise, as when they're still on the rate hiking cycle, and they have to somehow communicate to the markets that this is not a pivot, even though we're bid for unlimited and we're still on a rate hiking cycle, like that is a messaging like disaster nightmare. Like people don't believe the Bank of Japan right now. People don't believe the Fed right now, as it is. And so that's like a serious risk that can happen.
So what I'm extracting out of this is that the Bank of Japan isn't worried about inflation like they're claiming. They're worried about the collapse of the markets. So they're doing this monetary tightening, which affects the liquidity in the U.S. bond markets since they're such a major buyer. And this evaporation of liquidity could cause a collapse in bonds, not because of any economic factors related to the real economy, but affected simply by the monetary policy set out by the Bank of Japan. And these moves by the Bank of Japan is very similar to what we just saw the Bank of England have to do to support their gilt market. Now, if you're confused on what a gilt is basically just equivalent to U.S. Treasury, where the government is allowing people to buy their debt. They're considered really safe until they become dysfunctional, and then you have to provide support for them. Japan is having to do the same thing Bank of England did, which has a lot of people now worried about a sovereign debt crisis that's exploding to become a global debt crisis. But one of the things as Weston is hinting at is this isn't related to the actual real economy. This seems to be purely market mechanics just unfolding, something that can be contained. It isn't some sort of unfolding of a real economy feature where, we then see a complete collapse within debt markets everywhere and then a financial collapse. It doesn't seem anything extreme like that, but it could mean some capitulation in the short term of bonds. And just for a better visual, we can look at the England gilt market and we can see where they stepped in September and said, hey, we're now going to be buying the longer dated gilts to help support the market and bring it back to normal operations because it's become dysfunctional. And you see the massive drawdown that it had leading to that before they stepped in and became a buyer to help support the market. We can see that it's had a nice recovery since. Now, it doesn't mean that any of this is inevitable or for sure going to happen. It's just good to keep in the forefront of the mind. And it definitely looks like the market is trying to price this risk in. And so we're seeing some pullback when I was expecting just bullishness. I was expecting us to touch that 200-day moving average and then climb above it, especially with the Fed pivot that I'm expecting to come in early next year. So this does mean, however, that there probably will likely be really good opportunities in the future to buy in some more. For now, I'm still going to hold some of the position as well, and I've even kept some of the option contracts there, because if there is a big reversal, maybe a market crash, something like a COVID event, we will see a rapid spike in those long-term bonds. So I'm still fine keeping some allocation there. It's just important to de-risk when you see major warning signs like this. And on top of all of that, it's also important to note that for me, when it comes to my allocation and my risk management, this is new to me, this scenario. And I'm a relatively young in my bond trading experience. I've got a decade of experience in the market as a whole, but when it comes to trading bonds specifically, I've only got a few years built up now, which is actually the silver lining to all of this. These past few weeks have been very volatile. This past year has been very rough, very difficult to trade. This year has definitely been the hardest year to trade in my 10 years of experience in the markets. And it's great because you learn so much. If we ever hit times like this, I'll know exactly what to move and be that first person to move because I now have that experience. And that's the way I think a lot of people should be looking at this, because I see a lot of people upset in the moment and not, make sure you even write it down. Okay, when this happens, this is what occurred. Okay, these experiences are going to make you a better trader, a better investor. So you might take some losses. You might pay for those lessons. You might even be best to think of it as like college, right? It's still less than a degree for hopefully, to pay these lessons. All right. So, but the experience and knowledge you gain is going to pay tenfold whatever you experience now, even if what we're experiencing right now sucks. But honestly, this is a great point to also give a shout out to Marlo, who actually has been trading this market beautifully, absolutely killing it when it comes to the SPY trading that he's been doing as of recent. Completely creating this correction, making 400% returns this past week, made 100% returns on over 100% returns on 2 positions today, playing some puts into the downside, then play some calls in the upside. And then we both went short on the market coming into the close today as well, bought some long-term puts. Now, when it comes to SPY, this just looks rough. It looks like a mess. It looks like could be some potential chop. And what really is standing out to me to the market right now is Apple. Now, important thing to remember is that Apple's a large allocation in most large funds. Whether it's the SPY, where it's about 8% of the fund, or whether it's QQQ, where it actually has a similar allocation, Apple has found its way in everyone's portfolio, including Warren Buffett, whose 40% of his portfolio is actually in Apple right now. Now, he might be selling right now. This could be some of the capitulation that we're seeing in the market. We won't know until 3 or 4 months after the fact. But one of the things that we will look at, like Apple right now, is this very, very important level here. This huge 129 mark is a huge psychological level for Apple. If we break below here, it's actually a new low for the year, and I think it could cause some severe capitulation in the stock, which could cause a contagion effect that spreads to the S&P and the greater market as well. In fact, I'm kind of banking on that to be what brings us into some harder times next year, because remember, I've talked about many times before how this year's bad, next year it's likely to be rough, and there's a bunch of factors that are playing into that. And one of those factors is that many people are calling for a second wave of inflation. They're looking at history and saying, well, usually we have one peak of inflation, it comes back down, it's stagnant for a bit, or maybe even precipitously comes down a bit, and then we get a second one. And this second round of inflation is what a lot of people are saying is coming our way. Fears of stagflation are sort of coming back. And with also these debt crises going on, recession definitely looming and worsening, supply chain issues still a problem. Remember that starvation and hunger that we were talking about last year that's kind of come around? You've kind of heard about it. There's been some shortages. Yeah, that's going to be next year, and it's going to suck. With all that going on, I've actually been looking at gold and silver and some miners as some opportunities, as I see that we've kind of made some bullish turns in these markets. Gold seems to have double peaked right here, but we're seeing it start to come back a bit. On the TTM squeeze, you can see we've managed to stay bullish. On the weekly, we finally turned to over and getting bullish. So this looks like a signal for, hey, this might start to wake up and heading into next year when everyone's so afraid of everything going on. I'm looking at this as an opportunity. We've already actually played some gold calls as well. It gave 60% right now. We're coming into this pullback. Let me see. I think we played right here, rode these 2 days, sold last bit of the position yesterday, and looking to get back in likely again. As you can see, a little overbought in the 1 minute. I would like to see this chill out a bit, maybe chop some, and then I'd like to get back in, but we're getting pretty overbought right now. But this will be what I'm looking at for this time period heading into the beginning of next year as a good trade opportunity, especially since I pulled some of my allocations at LTLT. I'm going to be looking for different opportunities, ways to diversify in the market, what's bullish. And speaking of different things that look bullish on this market, remember we talked about UNG. I said, hey, this seems like chop in this level. I want to see a significant break. We saw a significant break to the downside. We actually went below my target I was looking for. Now on the 1 hour, we're pretty oversold on the RSI. It's looking pretty bearish until you include the fundamental conversation of what's going on within the gas market. And this has turned out to be a pretty cold winter. And boy, is Europe just scraping by. It's pretty incredible. But you have to consider these issues won't be fixed overnight. In fact, I'm expecting a lot of this to turn into a super cycle into the energy market. It takes a long time to set up a new pipeline and get that energy converted, or for us to open up more energy. We'd have to make like 50 different policy changes literally overnight, and then it would still take time to actually enact all of those for these problems to go away. They're not going anywhere. So any time that I see UNG get exaggerated on the downside like this, we're pretty oversold. I went ahead and started a position, and I'm looking to allocate more in that position from here. And if we tune into XLE, I'm thinking similar thing over here. XLE's had a break sell-off last week. We were talking about, hey, took a pause on the trade there. I pulled back some. I made another attempt at it, and it got burned out on the trade. But again, today, I set up some more calls, went very long on those because, again, the fundamentals here are so strong. So even if the starting position doesn't work the first time, I am still so solidified in what I'm seeing here. Now, we could see a touch to this 200-day moving average, but again, I'm just going to use that as the average. I bought some long-term calls. We're far out. We're going to let this play out a bit. Remember, China reopening is going to be a huge pull of demand on the energy markets. And when there's a lack of supply, it doesn't get much bullish and much more obvious than that. A good play like this, a good opportunity like this, I don't want to miss this move that I think is going to send this to new highs. And with crude oil as well. So you can keep an eye on those gas prices. Now let's talk about Tesla. I was talking about how Tesla could hit this low. We could see this chart play out, but I thought, well, maybe Elon will come back. Instead, he was making some tweets about wanting to leave or could leave, and there's been a bunch of speculation. And just over this time period, this stock has just completely capitulated at a 20 RSI on the daily chart, and today we touched our Fibonacci retracement. And I have to say, if you're short Tesla, I would get out. For me, remember, this is not financial advice. This is supposed to be educational in nature, but I would not be shorting Tesla right now. That is ludicrous after a big sell-off like this. And in fact, it's been great, actually, that Tesla really hasn't traded well with the market at all. Now, the market, ironically, was selling off today, but the market, when we had those fat rallies in SPY, Tesla was just like, no, and it just continued to sell off. The decoupling here, I think, could benefit Tesla if the rest of the market gets really bearish. And keep in mind that Tesla's also got different packages where they've been able to bring down the prices on their vehicles due to different government tax reliefs, which allows them to sell these vehicles at cheaper prices. And even though the market doesn't look so great there, it could help their sales coming in next year, which they really are going to need because automobile industries and during recessions tend to be some of the worst performers, which also could be affecting the stock. But again, I expect Elon to find a replacement for Twitter, not for Tesla. I expect him to come back. I expect this to be a huge swing in the stock. And when it comes to this whole story of, oh, Elon's going to get margin called because all his loans are backed by his stock and the stock is capitulating, I just don't see it happen. I think he's too big to fail right now. I think he could keep Twitter afloat, turn that ship around. They did more job cuts today. The company's still running fine. And again, I think that could be a signal to the other tech companies that, hey, you can cut some of your crew and you can still keep operations going. Now, lots of people are saying, well, he cut jobs and now it's going horrible. That's a lot of the comments that I see on the content that they create on the other social media platforms, not so much on YouTube, but on TikTok. Everyone's saying, well, obviously he made these jet jobs and Twitter's doing awful. Awful in what way? does the app work? Do the actual applications that the app is supposed to fulfill work technologically? Not do your whatever experience that you're having on the app. When no one cares. It still runs. That's what matters, and I think that is what's going to matter to tech companies and why they'll also do job cuts as well. Now, there's a lot more to talk about, and if this video gets 20 likes, I'll drop my passive versus active investing video. So make sure you're subscribed to the channel and punch that bell, because this is no bell trading. We don't need that around, but you still need a notification. Anyways, I'll see you in the next video.